say to people who say that you are not treating high inflation today like an emergency?
Well, I guess I would start by saying this, Nick, that we know that this is a time for us to be tightly focused on the path ahead and on getting inflation back down to 2%. We know how people are suffering from high inflation, and we have both the tools and the resolve to get inflation back down. And no one should doubt our resolve in doing that. And I think if you look at how quickly we've moved in the last few months, really, then you'll see that financial conditions have tightened quite a bit. What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that.
So to get into some of those tactics, the Fed raised interest rates at its last meeting by a half percentage point. That is something the Fed hadn't done since 2000. And you've said that you think the Fed may need to do that again at your next two meetings. Why are you being so specific? Doesn't that limit your options?
Well, I didn't say, so we make the decisions at the meetings. What I said was a couple of things. First, I said that we decided to raise the federal funds rate, range for the federal funds rate by 50 basis points at the last meeting. We also said that we thought ongoing rate increases would be appropriate. And during the course of the meeting, it became clear that there was very broad support on the committee for having on the table the idea of doing additional rate increases of that magnitude at each of the next two meetings. And that's what I said. And, that's short of a prediction or a statement or forward guidance that we're actually going to do this. But I would say if the economy performs about as we expect, then that's something that'll be on the table. And honestly, it's so things are so uncertain in the economy right now. It's very difficult to think about trying to give guidance out into the future. We don't know the path of the economy. There are many global events going on that can affect that are really not under our control as well.
So if the base case is to do a half point at the next two meetings, why not just do a percentage point at your next meeting, rip the Band-Aid off?
Well, as you know, inflation works through, monetary policy works through expectations. So markets are pricing in a series of rate hikes, a significant series of future rate hikes, amounting to already having done that. So we like to work through expectations, and I'm not blessing any particular day's readings, but it's been good to see financial markets reacting in advance based on the way we're speaking about the economy. And the consequence, as I mentioned, is that financial conditions overall have tightened significantly. I think that, if you broadly across financial conditions, you're seeing that, and that's what we need. What we need is to see really growth moving down from the very high levels that we saw last year, moving down to a level that's still positive, but that will give the supply side a chance to catch up and a chance for inflation to come down as we get supply and demand back back together.
A couple of years ago, you talked about moving slowly when you're in a dark room, when the lights go out. Obviously, things are different now. It's harder to do that. You're moving in much faster increments as you raise the price of overnight money. But I wonder, as you look ahead, what are you going to be looking for to determine whether to increase that pace of half percentage point increases, say to 3/4 of a point, or to slow things down to the quarter point increment by which the Fed has raised interest rates more often over the last couple of decades?
So
You see this app right here? It's called Audible. Using just this little app on my phone, I was able to replace my full-time income and quit my job, all because of using Audible. And for those of you that don't know what Audible is, it's actually a child company of Amazon, which is one of the largest marketplaces in the world. So Audible is where people normally buy and sell audiobooks and podcasts.
So I do think, by the standards of central bank practice in recent decades, we're moving about as fast as we've moved in several decades. But I guess the way I would say it is this. What we need to see is clear and convincing evidence that inflation pressures are abating and inflation is coming down. And if we don't see that, then we'll have to consider moving more aggressively. If we do see that, then we can consider moving to a slower pace. And it's going to be a judgment call that we make going forward as we carefully monitor incoming data, the evolving outlook. How are financial conditions changing? How are they affecting the economy? And that's how I think about it.
So back in 2016, you were a governor of the Fed, and in late 2018, you were chair of the Fed. There was a significant tightening in financial conditions. There were some global growth shocks. Global growth was slowing, and the Fed pulled back from its plans to raise rates maybe as aggressively as would have been the case before all of that happened. With the global shocks that we're facing now, the recent tightening in financial conditions that we're seeing now, what would you need to see on that side of the markets to reassess the pace of rate increases right now?
You know, the underlying strength of the U.S. economy is really good right now. The U.S. economy is strong. The labor market is extremely strong. Growth this year has been marked down, but is still at very healthy levels. So you saw today's retail sales number. The economy is strong. The consumer balance sheets are healthy. Businesses are healthy. The banks are well capitalized. So this is a strong economy, and we think it's well positioned to withstand less accommodative monetary policy, tighter monetary policy. Of course, we do monitor global events, and global events have been very important drivers of economic conditions lately. The war in Ukraine is something that has upset the global commodity picture, while also threatening the global order more broadly. And the rolling shutdowns in China are still going on, and those are having an effect on global supply chains, of course. So we watch those things, and we watch how they affect the U.S. economy. The effects are very uncertain. They probably weigh on growth, downward on growth, and probably push inflation up at the margin. But even through all that, we see the U.S. economy continuing to show real strength and be well positioned to handle the policy changes that we're making.
Chair Powell, a number of your former colleagues, Richard Clarida, who was vice chair until this past January, Bill Dudley, the former New York Fed president, have said recently that they think that the Fed is going to have to raise its short-term policy rate to 3.5%, maybe 4%, maybe higher. How are you thinking about the destination right now for how high you might have to raise interest rates?
So, as a policymaker, the way I'm thinking about it is that right now we're raising rates expeditiously to what we've been saying, to a more normal level, which is something that we'll reach maybe in the fourth quarter. But it's not a stopping point. It's not a looking around point. We don't know with any confidence where neutral is. We don't know where tight is. We just don't, and particularly in this environment of higher inflation and very strong growth and a really tight labor market. So what we're going to be looking at, meeting by meeting, data reading by data reading, is what's happening with financial conditions and what's happening with the economy. Really, what effects are changes in policy having on the economy? Are we starting to see what we need to see, which is a really clear and convincing evidence that inflation is coming down? That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down. We'll go to that point, and there won't be any hesitation about that.
Just as it can be hard for you to know when to stop raising interest rates, it can be hard to know when to start. And obviously, these things look blindingly obvious in hindsight. But I want to go back to last year and ask you, what went wrong last year from a policy perspective? Again, with the benefit of hindsight, knowing things now that you didn't know then, what do you wish you had done differently last year?
So we have to make.
You see this black box right here? Well, I'm going to show you something right now. Some people are concerned that they might have to go for a long period of time without power or electricity. That's why.
So we have to make these decisions, and we do make them in real time based on what we know at the time. And so I would say, if you replay last summer, we had a real spike in inflation that began in March, April, May, June of last year. And then inflation came down month after month after month for about 4 months, anyway, through the end of the summer. So we were concerned because we saw inflation spreading more broadly, and because we didn't see supply chain issues improving. We didn't see labor force participation improving. So we had real concerns. But still, the incoming inflation data were kind of consistent with our story. And then the data really changed, pretty thoroughly beginning in October, and we responded very much to that. So since then, we pivoted in our policy, and since then you've seen really quite significant tightening in financial conditions. I don't know that financial conditions have tightened more quickly than this in a very long time. And but that's what happened. And I've said for the last 2.5 months, I've been saying that if you look back in hindsight, give yourself 20/20 hindsight, then yes, it probably would have been better to have raised rates earlier. We were looking at some weak employment reports. We were looking at inflation reports that were coming down. When that stopped, and when the data started pointing toward a stronger economy with higher inflationary pressures, higher wage pressures, we didn't hesitate. From that point, we've really moved. I would say almost expeditiously. Since then, we have moved, and you see where we are 6 months later since that happened. You now have the 10 years up, 140 basis points. The 2 years up almost 200 basis points, and the 2-year Treasury is a pretty good measure of policy expectations. So quite a lot of tightening, and appropriately so. Inflation is way too high, and we need to bring it down, and we're going to use our tools to do that.
Obviously, the pandemic has made economic forecasting more difficult than it's been in a long time, and I wouldn't presume to think that it's easy. But looking at demand last year, the fiscal stimulus that was approved by the administration and Congress last March, it was far larger than what your own economists at the Fed were anticipating. Did that end up putting the Fed behind the curve in terms of you just didn't judge demand properly because of the much larger stimulus that was approved?
So it's really not our role in economic policy within the government to reach judgments on economic actions taken by Congress or by the administration. There are other parts of the government that do that exact thing, but it's really us. So I guess I would say that there was a lot of stimulus put behind the U.S. economy. That was both monetary policy and that was fiscal policy. But still, you can't get the kind of inflation that we've gotten out of that much demand. That was a lot of support for demand. You can't get the kind of inflation we have without these supply bottlenecks that we've had, and that includes the supply chain problems that we've had and the shortages. If you look at automobiles, that's a great case. Ordinarily, car makers would have just made more cars. There was tremendous demand for cars, but for really idiosyncratic set of reasons, there weren't enough semiconductors, so there aren't cars, and so you have tremendous vehicle inflation. That's just one example. Same thing, we didn't see. We had a real hit to labor force participation. We didn't see that coming. And so really these supply side factors, you have to add them in to any kind of economic model to get the kind of inflation that we have. We clearly had very strong demand, and we knew that. What we didn't know and anticipate was how large the supply side effects would be and how persistent they were. And we now know that in hindsight, and we see how sticky they are. And so, as I've mentioned, we're now not setting policy on the expectation that we get relief on the supply side until we actually do.
All right, so that was 2021. Then comes along 3 months ago, the war in Ukraine, which has obviously been enormously disruptive to millions of people in Eastern Europe, but also has had a profound effect on energy markets, commodity markets, and we also have new lockdowns in China. How have those events changed the difficulty of what it is that you are trying to do?
Well, I mean, clearly they've raised the degree of difficulty for, more importantly, for the people around the world who are looking to have a continued expansion in the economy, but also for us from the standpoint of policy. So, you know, the war in Ukraine is pushing up commodity prices for both food and energy. And we don't really know how long that's going to last now. It might have thought at the beginning, and we don't make those kind of judgments, that it wouldn't be long lasting. Now it looks like it may be, so that may be a persistent effect. Same thing with the rolling shutdowns in China. They won't last forever, but they'll last for some time, and they're having an effect too. And what they're doing is they're preventing any healing of supply chain problems. So that's going to make it harder for inflation to come down, and so really they've added to the degree of difficulty to what was already a challenging project.
So we heard here before lunch from Barry Biffle, the CEO of Frontier Airlines. He says he's raising prices because of fuel costs, and there's a pilot shortage. And now those are things outside of your control. But you said just now that the Fed can no longer set policy on the hope or expectation that supply chains will give you a lot of help here. So what does that mean for Fed policy? If these things are out of your control in the supply chain, or if energy markets don't improve anytime soon, what is the implication of that for policy?
Well, it doesn't have much of an implication in the near term because we clearly have a job to do on demand. So there is an imbalance in the economy broadly between demand and supply. And so we can't really affect supply. The things that are really supply side issues, our policies don't work on those. But we have a job to do on demand. And I would, for example, point to the labor market where there's more demand for workers than there are people available to work by a substantial margin. And so that means that wages are moving up, which is a great thing, but they're moving up at a pace that is not consistent with 2% inflation. So there's a pathway for us to use our tools to try to moderate demand, still to a positive level, but not at the high level that it was at, for example, last year, and try to get demand and supply back into alignment in the labor market or close to it, so that there'll still be positive wage increases and healthy wage increases, but they'll be at a level that is more consistent with 2% inflation. Wages are a very important determiner of inflation over the longer term. So that's just an example of what our job is, and we think we can do that job. In the meantime, of course, everyone is looking for the supply side to heal more. We don't see much evidence of that yet, but I mean, I still think in the longer run, that has to be coming. There will be semiconductors and other things that are in short supply right now.
A lot of people, though, are skeptical that you can get inflation down to your 2% goal without a recession. What do you know that they don't?
I don't know anything that they don't. I mean, I would say there's no disagreement here, really. It is going to be a challenging task, and it's been made more challenging in the last couple of months because of global events. So it's challenging because unemployment is very low already, and because inflation is very high, and so. But I will just say there are pathways. Clearly there are pathways for us to be able to moderate demand, get demand and supply back in alignment, and get inflation back down, while also having a strong labor market. Doesn't mean that the unemployment rate needs to remain 3.6%, which is a very, very low rate, historically low. It's 1/10 above the 50-year low. You'd still have quite a strong labor market if unemployment were to move up a few ticks. So I would say there are a number of plausible paths to having a soft, or as I've said, soft-ish landing. And, our job isn't to handicap the odds, it is to try to achieve that. The last thing I'll say, though, is that achieving price stability, restoring price stability is an unconditional need. It's something we have to do because really the economy doesn't work for workers or for businesses or for anybody without price stability. So it's the bedrock of the economy, really. And so that's something we need to do if we want to have the kind of labor market that we all want to have, which is one where there are tight labor market conditions and wages are moving up and people are changing jobs and opportunity is growing and all of that. But inflation is not high and eating up people's paychecks.
So, Chair Powell, I heard you refer to a softish landing, and I want to ask, what's the difference between a soft landing and a softish landing? Because if the pilot tells me, don't worry, we're going to have a softish landing, I don't know, I start to wonder what he's talking about.
Well, so you fly around, sometimes the landing is just perfect, right? And sometimes it's just a little bumpy, and so it's still a good landing. You don't even notice it, right? So, but in this, what does it mean in this setting? So I guess I would say this: we have to get inflation down to 2%. We've got to restore, our definition of price stability, and we will do that. It will be challenging to do that we have to slow growth to do that. That's the idea, is that growth has to move down. That's what has to happen for inflation to come down. We don't have precision tools. We can't say let's dial it into this exact level. We raise interest rates, that affects financial conditions, and financial conditions affect the economy. So there are a couple of steps there, and it is not in any way a surgically precision set of tools. So I would say there could, as I mentioned, there could be some pain involved to restoring price stability. But we think we can maintain a strong labor market, defined as a labor market where unemployment is low and wages are moving up and that kind of thing. It may not be the perfect labor market, but it will be a strong labor market.
So I'll move on from this subject, but I want to ask if there's a historical example that you could point to for what you're trying to achieve. Some people talk about the late 1990s, but even then the unemployment rate continued to drift lower after the Fed raised interest rates. So is this something that we have any recent historical experience with, what you're trying to do here?
Well, so you can look back to 1960. There have been 11 tightening cycles. And in none of those cycles do they look anything like the current cycle. We've never, I won't say never, but I'm not aware of a time when we've had 2 job openings for every unemployed person. And it's just an extraordinary, it's a once in a century pandemic, followed by historically large fiscal and monetary policy support, followed by a war in the middle of Europe between 2 commodity makers, followed by partial shutdown of China, a very large economy. That's the manufacturing center, one of the manufacturing centers of the world. So can you look in the history book and find that? No, you can't. And so I just think we're in a world of firsts. So I wouldn't say just because it's never happened before, it's impossible. I wouldn't say that. I would say that there are plausible paths, and that this will be challenging, but we'll do our best to achieve it. And in any case, we will achieve price stability.
So what are you looking to see, either in inflation or in financial conditions, that tells you that things are moving in your direction? Because it feels like there's a chance here that inflation does come down in the second half of the year, even though it'll still be above your target. But there's also a chance that the labor market tightens even more. And I wonder how you would, I know it's hard to respond to a hypothetical, but that doesn't seem like a crazy hypothetical to be considering right now. A situation where you do get improvement on inflation, but you do continue to overshoot an estimate of what might be considered a more stable employment situation.
Well, the main thing is to get inflation down. We all read, of course, everyone reads the inflation reports very carefully and looks for details that look positive and that kind of thing. But truthfully, this is not a time for tremendously nuanced readings of inflation. We need to see inflation coming down in a convincing way. That's what we need to see. And until we see that, we're gonna keep going. We're not gonna assume that we've made it until we see that. And we're not seeing that right now. There are some promising signs. You can point to them. There are some signs that are not promising. But really, that's what we're looking to see. So, with the policy rate where it is, you don't need to. I mean, what we need to do is push ahead with rate increases, and make the evaluation that I mentioned earlier. Is this the right level? Should we slow down? Should we speed up? I think that's what we'll be doing as we see incoming data, and make a judgment about where are we? Have we gotten as far as we need to get? And until we do, we'll keep going.
Now, a number of people have suggested to me that the one thing that might slow you down, or at least make this much more difficult, would be some kind of market cataclysm. And I wonder, in part, if that's why you're trying to be more transparent, not erratic, making sudden moves on your policy moves. But my question there is, where's your level of concern that financial stability and controlling inflation by raising interest rates, maybe a lot, might be fundamentally incompatible in that raising rates causes financial disruption but doesn't actually bring inflation under control? Where is your level of concern around that situation?
I don't see that happening. I mean, we monitor a very broad range of financial conditions, and we're doing that now. We'll keep doing that, and they're different cycles look different. Sometimes the tightening takes place in one market, sometimes in another, sometimes in credit spreads, sometimes in all of them. So we're watching them all, as a group, and of course. Their volatility has been up a little bit, and that has some effect on liquidity in some markets. But nonetheless, the markets are orderly; they're functioning. I think they're processing the way we're thinking, the way that the FOMC is thinking about policy, pretty well. And I think that the idea again is to have financial conditions tighten to the point where growth will moderate and still be positive, but moderate to the point where supply and demand can get back in alignment, and where we can get inflation back down to 2%. And I see that broadly working pretty well right now. Obviously, there are some volatile days and volatile markets, but so far, I see us as getting through this fairly well.
So this is the Future of Everything Festival, and in the time we have left, I want to look ahead at some of the issues on the horizon for the economy. Labor shortage. I wonder if you see that as something that might be a more persistent rather than just a cyclical feature in our economy. I mean, if you look at net immigration since 2017, because of policy reasons or the pandemic, it's been basically flat. Are labor shortages here to stay, and what would the implications of that be for the Fed?
I think there is a risk that we'll have a persistent imbalance between supply and demand in the labor market, and you put your finger on it. It's part of its population. There's the labor force. There's the labor force participation rate. But if the population is growing more slowly, there are going to be fewer workers, and that's a big part of the story. Really, in recent years, is immigration's been quite low. These are not tools or things that the Fed has, or places where we seek to guide policy. But if you have a slower growing labor market, you're going to have a smaller economy, and you could be in a situation where these wage pressures remain longer. Of course, we'd love to see labor force participation come up, but I do think I think that's a risk in the medium term, but it's really one for other policymakers to look after.
And related to that, economists have this concept called the natural rate of unemployment. The idea that when the economy is finally balanced, there's a level of unemployment that corresponds with stable inflation. And I went back and looked. When you joined the Board of Governors almost exactly 10 years ago, the participants once a quarter project where they think these things are. And so in 2012, you and most of your colleagues thought that level was between 5 and 6%. Now you and your colleagues have been writing down that it's somewhere between 3.5% and the low 4% area. But how much weight do you put on the prospect that the natural rate of unemployment, perhaps temporarily, perhaps not, has actually shifted higher and might be closer to where you and your colleagues thought it was 10 years ago?
Well, no, I think that may well be right. I think there was a tremendous amount of turbulence in the labor market, and so in theory, the sort of matching function that is the labor market could be disrupted. People are changing jobs at all-time record rates, and there's just a lot going on. People are reevaluating their commitment to the labor force. So all of that points to a higher natural rate of unemployment. But the other thing that's clear, though, is that the effective natural rate can change pretty significantly over the course of an expansion, particularly a long expansion like the last one, where you finally had 3.5% unemployment and no sign of either wage or price inflation. But you had a couple of years there where unemployment was well below 4%, and you didn't see inflation. So that suggests that as that longest expansion in recorded U.S. history, 10 years and 8 months, as that went on, what you saw was matching getting better and better and better and more efficient, and the natural rate coming down. So right now, it feels like the actual unemployment rate is not the perfect. You have to think about where the natural rate is compared to today's employment rate, and it does appear to me that it's probably well above 3.6%. But it should shift down as this highly unusual time in our economy and in our labor market goes on. We should see that settling down, and we should see the natural rate declining, and that itself could reduce wage pressures and inflation pressures.
Well, all things equal then, I mean, would you, as the chairman of the Fed, feel more comfortable today if the unemployment rate were a little bit higher, somewhere in the 4s instead of in the 3s?
I'm never going to say that more people need to be out of work. I would love to see a labor market that's more in balance, and ideally that would start with the number of vacancies coming down, and that's one of the things that is vacancies and quits are at all-time highs, and that suggests a labor market that's out of balance, and there's more demand than there are workers. So I'd love to see people come back into the labor force, and we are seeing some of that. We'd like to see that continue, and we'd like to see the job vacancies level come down so that you're seeing supply and demand get back together, and the unemployment rate will shake out where it needs to be. It's as I mentioned, it's close to a 50-year low right now.
Moving from sort of the post-pandemic labor market to the supply chain and inventory management, it seems much more possible than it did a year ago that we're going through a big shift in how businesses manage the supply chain, and the forces of the last 25 years that really helped central banks keep inflation low, businesses pricing an efficient supply chain now you might want resilience. You might want to source goods from multiple suppliers. That could embed higher costs. So what would be the implications for the Fed if we're going through some kind of regime shift where those forces that helped bring prices down over the last 3 decades are reversing now?
So I do think you've had sort of a perfect storm of disinflationary forces for the last quarter century, and that's globalization, amplified by technology, its aging population, certainly in the Western democracies, and all of that and low productivity, that has all led to disinflation. And so some have been making the argument for years now that those forces were all going to flip. I don't think they would flip overnight, but I would say, certainly in the near term, there is a real possibility that globalization will go into reverse to some extent. And, the trade-off would be those supply chains were very efficient, but they weren't very robust. And they broke down pretty badly in the pandemic. So, I mean, to the extent you do that, you'd have more security in your supply chain, more stability perhaps, but it might not be quite as efficient as the amazing global supply chains that we had, which were very, very fast and flexible and all that. So I'm not sure what the overall you could see higher inflationary pressures for a time, but at the same time, policy could respond to that. So I don't know that you'd see higher inflation. So it's hard to say. Globalization obviously brought its costs and its benefits, and it benefited lots of parts of the world. And from our standpoint, we got a lot of products cheaper, but our manufacturing base in the West is vastly diminished. And you're right. It would be a very different world if we see that go into reverse or pause.
We're almost out of time. I'm going to try to sneak in one last question to you. You were confirmed last week to a new 4-year term with significant bipartisan support. Someone joked to me, you see that sort of support only to adjourn the Senate these days. You've been through a lot in your first 4 years as Fed chair, especially in the last 2. Is there anything you've learned in that time that might change your approach to this job in the next 4 years?
You know, I think that there's an overwhelming need to get inflation under control, and that's what I'm thinking about. And that's what we're thinking about here at the Fed. In times when, you know, you're at 2% inflation and the economy is growing and unemployment's really low, you can have a more balanced, thought about what you should be doing at work. I think we know what we need to be doing at work right now, which is to get inflation under control, and we'll use our tools to do that. That's my dominant thought about the future at the Fed. It's a great honor to be able to serve a second term, and of course I'll do my very best, to carry out our obligations under the dual mandate, and leave it there.
Well, Chair Powell, thank